Welcome to Greenshoe Radio, brought to you by Greenshoe Media Group. I'm your host, Mark Bunting. Our guest today is Aurora Davidson, CEO of Amerigo Resources, which trades under the ticker symbol ARG on the TSX and on the OTCQX under ARREF. Great to see you again today, Aurora.
Mark, great to be here and providing an update about Amerigo.
Absolutely. The company released Q3 earnings last week, and as you said, they were negatively affected by what you've called the tremendous downdraft in copper prices, but you did meet your production and cost objectives, and you had positive EBITDA. So how would you characterize the quarter?
Yeah, that's a good place to start our chat today, Mark. Amerigo had a strong operational third quarter. In our case, the single most important driver for strong operations is production. How does our actual production trend against our guidance? In that sense, we beat our own target. Amerigo's production to September 30th has been 3% over guidance. Now, in addition to our production results, there are other operational KPIs where our MVC team in Chile continued to operate strongly. For example, we had no operational issues during the quarter. We had no lost times due to accidents, no environmental incidents. Our plant availability was 98.5%. That's really, really good. And we continue to have a strong level of water reserve. So all the boxes were checked. Now, in respect of financial results, Amerigo's third quarter was impacted by, I mentioned that on the call, declining copper prices, and this resulted in a net loss of $4.4 million. But that included $8.6 million in negative copper price settlement adjustments to the second quarter production. Now, the settlement adjustments came from a 60-cent per pound decline in copper prices from the price that we had provisionally booked at the end of Q2, which was $4.10 per pound, to the prices that we realized in the third quarter, which were $3.50 per pound. Now, the good news, Mark, is that we are not seeing the same steep decline in copper prices we faced in the third quarter in the current quarter.
Right. Let's pick up on that. You've said that demand out of China and the EU has been quiet, but also you believe there's a disconnect between the price of copper and the tightness in the market, maybe only about 5 days of supply out there. And you also think, and you hinted at there, that copper prices may be bottoming. So can you elaborate on that?
Sure. Well, actually, what I meant was that additional demand is quietly building up in China for electric vehicles and in Europe to start ramping up their solar capacity. Press reports keep talking about how demand will build up to advance the energy transition, but perhaps it's already quietly building up. The main point I wanted to convey in our earnings call is really the disconnect between the cautious macroeconomic sentiment, which spills over into a weak financial view of copper, with the tightness in the physical copper market. In other words, the financial markets have been having a negative view on copper, but the physical copper markets are super, super tight. You mentioned 5 days of global consumption in visible stocks. It's apparently now down to 3 days of visible stocks, which is unheard of. Through 2022, what we have seen is a common theme of copper supply challenges. Just today, I was reading a piece of news from the Chilean Copper Commission that reported that Chile's copper output fell again in September, now for the 15th month in a row. And this is important because, as you know, Chile is the world's biggest copper producer, and its production so far this year is down 7.5% from the same period in 2021. Now, on the other side, we have seen that copper prices have been affected from May 2022 on by a strong US dollar and fears of an economic slowdown, which, going back to your first question, resulted in the steep decline in copper prices in the third quarter. However, Mark, I don't think that under this scenario of stressed supply and low inventories, copper prices will continue to drop significantly. Copper prices may have well reached their bottom and could be headed towards a structural repricing.
Now, Aurora, on another front, Amerigo has paid out more than $24 million to shareholders year to date through the dividend and share buyback programs. The yield on the dividend is around 12%. And as you know, when a yield on company X, let's say, gets that high, some investors start to worry. But what makes the Amerigo yield sustainable?
Mark, our objective is for Amerigo's quarterly dividend to be sustainable and safe. That is why we have set that dividend at a rate of 3 cents Canadian per share per quarter. The sustainability of the quarterly dividend is based on the amount of operating cash flow we generate, which in turn depends on 3 factors: production, our costs, and the price of copper. If we look at production, and we discussed that in the first question today, one should analyze whether we're producing what we intended to produce. And as I mentioned earlier, our production has trended 3% over guidance so far this year. We had the same situation last year because we have a consistent and reliable operation. Now let's look at costs. Despite high inflation, our production costs so far this year have been 2% over budget, vis-a-vis production being 3% over budget. So we're not eroding margin through high costs. And the third aspect is copper price. Despite the volatility in copper price we have seen this year, we have continued to pay the quarterly dividend and have maintained strong cash balances to withstand low copper price periods. These are the factors that make the Amerigo quarterly dividend sustainable. Now, when we get to periods of higher copper prices, Amerigo has 2 other tools in its return of capital policy, which are share buybacks and performance dividends. We have not yet used the performance dividends, but they are designed to provide us with that additional flexible layer to return capital to our shareholders when conditions permit, without creating a high enough quarterly dividend that would not be sustainable under different copper price conditions.
Now, on the news front, you've struck a new 3-year labor agreement with MVC, which employs about nearly 200 people. And that gives you cost certainty. The agreement includes a nearly $3 million signing bonus. So can you just give us a brief overview of the details there?
Sure. Well, in Chile, where our MVC operation is located, collective labor agreements are always accompanied by the payment of signing bonuses to the workers that are covered under the agreement. The signing bonuses are not token payments. They can be significant, and they are a known cost of doing business in Chile. Labor agreements have a maximum term of 3 years, so everybody tries to get an agreement for 3 years. At the end of last month, we entered into a new 3-year labor agreement with MVC's Union of Workers, which is the most significant union we have at the operation and has a total of 198 members. The cost of the bonus was $2.9 million. We paid 50% of that already last month, and 50% will be paid in the second week of November. Now, the full cost of the signing bonus has to be expensed in the fourth quarter. That is a requirement of the accounting rules. We cannot expense it over the 36 months of the agreement. The good news is that the agreement really provides us with the ability of modeling out our labor costs for the next 3 years, and also provides our workers with a good contract under which they can continue to be motivated to contribute to the company's production, safety, environmental, and cost objectives, Mark.
Now, on the branding front, I think it's interesting, Aurora, that you're looking to emphasize to investors through a new investor presentation and a new video that Amerigo is not a mining company. Do you run into that a lot, that people tend to misconstrue what the company does? And are you essentially saying here that Amerigo is sustainably producing a critical metal for the green economy? Is that the crux of it, the message?
It is. Really, our goal is to explain to the investment community what Amerigo is and what Amerigo is not. We are not a traditional mining company. We're not exploring for reserves. We have no environmental liabilities. We have no geologists on our payroll. We don't require to invest substantial amount of capex every year to maintain a life of mine. What we do is that we recover copper from material that already exists, that has already been mined. We produce copper in amounts equivalent to what a mid-sized traditional mine could produce. And so this is a totally different business and investment story that needs to be clearly explained as such, and that is what we're doing.
Aurora, as you know, Chileans recently rejected a new constitution that contained some proposals that were deemed to be unfriendly to the mining sector. Now, do you believe that the new constitution, whenever it comes, will contain some actual tax incentives for a mining sector or and/or tax relief of some sort?
That's an interesting question. I don't know if there will be a brand new constitution or whether the current constitution will simply be modified to address some of the social concerns that emerged 3 years ago in Chile, and which originated the move towards changing the constitution in the first place. Now, in an ideal scenario, any changes to the constitution should continue to address the significant importance that mining has in Chile and to provide legal, permitting, tax and labor frameworks that ensure that mining is competitive and continues to benefit Chile. I don't think that the mining industry is asking for additional incentives or relief. It is simply looking for certainty to continue to contribute to the growth of Chile.
And lastly, Aurora, you referred earlier in our conversation to how people are perceiving the global economy. A global recession appears to be looming, according to some. Maybe we're in it already. But longer term, looking out, let's say to 2030, if not beyond that, what factors give you confidence that Amerigo Resources and copper itself will see strong demand?
Yeah, that's a great question. The argument we have for copper, Mark, is based on the fundamentals of growing demand and shrinking supply. You really have those two opposing forces in front of us. Copper demand grows annually at a rate of 1 to 2%, but additional demand associated with the energy transition is expected to be quite material. Some people talk about 4 to 5% additional demand per year. On the other hand, supply, as I explained earlier, has been stressed out. Mines are facing lower grades, and it will probably continue to be stressed out given the complexity of permitting, building, and operating copper mines. So if you put these two factors together, really two opposing forces, you could expect a substantial and chronic gap between copper supply and copper demand that will support copper prices. Now, we're not talking about small gaps here. The gaps could be very substantial. For example, some studies predict that the annual supply gap could be anywhere from 5 to 10 million tons by 2030. And just to put this in context, a 10 million ton supply gap is almost 50% of current global copper production. So filling a gap where you're expected to essentially produce 50% more of what is currently being produced would be a monumental effort, and higher copper prices would be needed to restrain demand and to incentivize new production. That's why we are very positive on the long-term outlook, the midterm outlook actually as well, of copper.
It's always great to get an update on Amerigo Resources, Aurora. It's such a unique story. Thanks so much for your time, and we'll talk to you next time.
Thank you, Mark. Glad to be here.
All right, our guest today has been Aurora Davidson, CEO of Amerigo Resources. It trades under the ticker symbol ARG on the TSX and on the OTCQX under ARREF. You've been listening to Greenshoe Radio, brought to you by Greenshoe Media Group. I'm Mark Bunting. Thanks a lot for joining us, and we'll talk to you next time.